Hi, this is Sive Morten with the daily update on EuroFX. I post my exclusive market overviews with the key political and economical events, charts and important levels on the forexpeacearmy.com forums weekly. This short video is a response to rapidly changing situation on the currency markets and should help you to stay on top of the game and be profitable. I suggest you to visit forexpeacearmy.com forum and read my analysis for the week before watching this daily video.
Welcome back, everybody. Let's take a look again on the gold market. Today in the weekly report we have considered some fundamental issues. So lots of rumors and talks about the stock market right now, that it shows good performance, and then actually we have the good boost from the recent non-farm payrolls release, from the CPI numbers, and you could actually see in the headlines this whole inspiration around this topic, that everybody inspired with maybe soft landing of the recession, and Fed maybe will not need to raise rate aggressively, and still some hope to maybe even escape the recession. But here we agree with the Morgan Stanley, who said that it's too early to celebrate, and it's just one outbreak of the CPI in general, in the decreasing of the CPI because of the decreasing inflation in the energy sector. This is nothing surprising, because energy sector right now includes big war premium, and additionally, as the global economy is turning to the slowdown, the demand for the hydrocarbons naturally decreasing. So that's why the drop of the extreme inflation in the hydrocarbons prices, this is absolutely normal thing. The one thing that we have to pay attention to is the change of the inflation in other spheres: medicine, services, goods, even food, although it usually exclude from the core CPI, but food is important. And if you'll take a look on other spheres, you will see that maybe they are rising not as fast as energy, but they are rising stubbornly. And inflation currently stands without energy around 6-7%. So our task here with the CPI is to keep watching what will happen with the core CPI, with the other spheres except the hydrocarbons, whether they will be keep rising, and what will happen. Our suggestion that this core CPI inflation also will keep rising just because of the policy of the Fed. All the stuff we have described and explained in our weekly report, as usual, making the conclusion on this. So if you would like to, you could read it. Speaking about the technical side, in general, overall long-term picture suggests, and well, actually stands positive for the gold, because take a look by yourself. You could see a softer Fed policy because at least currently we have better statistics. So it's not necessary for the Fed to hike rate aggressively. At the same time, we definitely know that they will not raise rate to the parity with the inflation. They just can't do this. That's in general positive factor for the gold, because it tells you that real interest rates always remain in a negative territory. I mean, until the crisis stands underway. So additional quantitative easing program from the Fed, from the government, injects more liquidity in the system, which tells you that probably the core inflation will keep going higher. And finally, geopolitical and the domestic political risks and confrontation in the United States bring nothing good to stability, and that's actually also supports the gold. So sooner rather than later, but investors start thinking about the gold again, I suppose. And I not exclude the situation where we already see the first stage of reversal. That's also might happen. At least our bet on the 1660, 1680 area that we said is approximately initial area where you could invest a part of your capital in the gold if you intend to, now is working. So market shows very nice bounce for the $20 per contract. Potentially the pattern that could really clarify everything is possible head and shoulders of the daily chart. This is actually the major pattern that we're watching here. If we'll get pattern here, it means that the strong and maybe even major reversal is coming, because this is really extended pattern on the daily chart that will be formed within the few months, starting since the middle of the May and by the end of the August. So this is 3-4 months of the progress, and that's important. But meantime, while we're still going higher to this level, we're just moving steps by steps with the intraday performance. So on the daily chart, as you can see, barely something has changed. Market still stands around the confidence, and here trend stands bullish, and here we do not see any reversal background by far. It means that if you would like to take the long position, well, at least by the common approach, you have to wait for a pullback, because this is not really wise to take the position when the market stands in the confidence. If you would like to take the short position, you have no choice but keep an eye on intraday charts and trying to catch the bearish pattern and make the take the position with this pattern on a possible downside bounce. That's the simple logic that we have currently. By taking a look at the intraday charts, here we start getting more and more bullish signs. Actually, we mostly talked about this on Friday. So you can see that market is not hurry up with the pullback after the XOP being met. So you can see that market tested it, but turns to the sideways action. This is not the way how usually market responds to reversal. So if market intends to show the reversal, intends to show the strong pullback, it usually starts faster, something of that sort. So market hits the XOP, for instance, and then showing downward action. Here we would not see it. Market turns to the consolidation. It now looks more like the building an energy process for a possible breakout. This is not a bearish performance, and with this divergence, this is actually not a divergence. This is a kind of the bullish dynamic pressure. Signs of the bullish dynamic pressure. The same thing we could say about the hourly chart. So we already shown it on Friday. So first of all, upper channel has not been broken, and market, take a look, has shown nice bounce up from its lower border and forming kind of the sideways consolidation as well. On Friday, we said keep an eye on this 1880, 1882 area. That will clarify you whether market is ready to go down or not. As you can see, market is not ready. That's why for the bulls, it might be additional option for trading being used. For if you're risky enough, you could think about taking the stop buy order, placing the stop buy order slightly below the XOP, because technically market has no reasons to retest the XOP. Its major target already has been done, except the direct breakout. So if you place stop buy order right there, you will be it will be executed right in the moment of the breakout. And if breakout really will happen, you will be already with the position is moving above it. But order should be placed slightly below the top, because if you place it above it, you could get some slippage or something of that sort. This will be more competitive execution of the orders in the moment of the acceleration. So that's why it's better to do slightly below this area. But if you're, as I said, risky enough to consider this trading setup, for others, classic approach, as I said, just waiting for the pullback. Waiting for retracement, watching for patterns that we have, levels that we have predefined previously. So when the 1770, 1750 area seems, 1760 probably, seems not bad actually to consider taking the position here as well. So let's see what the performance we get next week.